Hey everybody, welcome to today's quarterly market review. My name is Kevin Lau. For those of you that don't know me, I am the founder and lead financial planner for Imagine Financial Security. We are an independent financial planning and investment management firm based in Jacksonville, Florida, serving clients both locally as well as across the United States virtually. This is for educational purposes only, so please do not take this as direct investment, legal, or tax advice. Everyone has their own unique circumstances, so you've got to consider those before making any changes to your situation. We're going to be posting all of these reviews on our YouTube channel, as well as other retirement tax and legal tips. So make sure you subscribe to our channel so you don't miss out on any of the good stuff. So we are going to dive in. We've got a lot to cover today. Key discussion points we're going to go over. We're going to first get the bad news out of the way and talk about the second quarter asset class performance review. We're going to hopefully answer or help answer the question, are we headed for a recession? Are we already in a recession? And we're going to talk about inflation. And then finally, we're going to talk about the bear market that we have officially entered into with the S&P 500, which is measured by a 20% drop from the previous high. We were already in a bear market with the NASDAQ. Now we're officially in a bear market with the S&P 500. So what does that mean for your portfolio? And what does that mean for the outlook for the future? And then we're going to talk about actions you can take now. Many people try to bury their head in the sand and just try to throw away their statements. I've heard clients sometimes tell me that, like, Kevin, I just tear my statements up, or I shred them, I burn them in the fire pit. But here's some actions that you can take now to take advantage of this downturn, because these don't come along very often. There's bull markets last longer than bear markets. So these are things that you can do now to help improve your portfolio when we do go through the recovery process, which it will happen. It just the question is when. All right, so performance review. There's really, I think the theme here is there's been nowhere to hide other than just simply cash on hand. But you look at the year-to-date performance, the best performing asset class is bonds, U.S. bonds, at minus 10%. The best performer. That's pretty eye-opening because usually bonds have an inverse correlation to stocks. And stocks, so far year-to-date, U.S. stocks are down about, like I said, 20%. International stocks about 18%. Emerging markets down about 17%. So everything is in the red. It was a painful quarter. There's been a lot of bad news out there with inflation, with the Fed essentially with their rate hike strategy. And so there's really been nowhere to hide. But there is more to the story than just looking at the broad-based asset classes. And one of those stories is between value versus growth. We talked about this last year in 2021, where when we go into a cycle of increasing interest rates, that impacts growth-oriented stocks because they rely on borrowing, they rely on leverage, and as leverage gets more expensive, it's going to be harder for those companies to grow. And that's played out where growth is down year to date 28%, whereas value still down year to date, but only 12% down. And so the rebalancing that it took place last year in 2021, where we took some of the gains off the table in growth, which has been the leading asset class over the last decade or so, since 0809, since the major Great Recession. And so that play has worked out extremely well to mitigate the risk in our client portfolios. And so if you have a 401k or an IRA out there, and you've been kind of just letting it ride over the last 10 years, you are likely overexposed to growth stocks. So you might want to look at your account and say, hey, is there opportunity to rebalance and add some value stocks in the portfolio, not just in US and not just in large cap, but this is the same story across all of the major asset classes: international stocks, emerging market stocks, small cap stocks, mid cap stocks. Value has been outperforming growth. So if you haven't shifted over, if you're a little bit late to the party, it's okay. I still believe there's a lot more leg that value is going to have to run on relative to growth going forward. And so make sure your portfolio is well positioned as we continue to go through this rate hike cycle. Fixed income, if you're late to this party, it's probably too late. Last year in 2021, we talked about shortening duration significantly. We wanted to prepare for the rate hikes. We wanted to make sure we weren't exposed to longer term bonds, because when rates do go up, we wanted to make sure we were able to reinvest those fixed income securities that were maturing, that we can reinvest now at higher interest rates. That's come to fruition. So far, March and April, we took significant advantage to the rising interest rates. And there are coupons out there on the municipal markets as well as the corporate markets that are now crediting 4, 5, even 5.5%. Treasuries 3% plus, CDs over 2%. So there's opportunity now that yields have come up. But if you were already long in duration and you've taken the hit on the value of your bonds, there may not be a ton you want to do. You might just want to kind of ride it out. But for our clients, we've had discussions about this, and if you've been paying attention to my quarterly reviews, that shortened duration has really made an impact, not necessarily eliminating the risk of the price decreases that we've experienced. I don't think anyone saw, how much prices were going to go up, especially on the short-term bonds, but it helped mitigate some of that volatility and now is allowing us to reinvest at those higher coupon rates. So I'm super excited, where yield is in the fixed income markets and the opportunities that we've already taken advantage of in the first and second quarter of 2022. Bitcoin, I mentioned, I'm just throwing this out there. I don't recommend Bitcoin in portfolios at this point in time for my clients. I'm a big believer in the blockchain. I like what the blockchain has done in terms of, creating, a platform for transactions to happen in a private manner. But there's a lot of uncertainty around government regulation. There's a lot of uncertainty about the actual value of not just Bitcoin, but all of the other alternative crypto assets. But I just put this graph out there for fun. After the first quarter, Bitcoin was down 10% year to date. Now it's down 57%. There's been a significant sell-off in crypto. There's a lot of liquidity concerns. There's a couple of major players in the crypto space that are filing for bankruptcy. So there's a lot of red flags in crypto. If you don't understand it, don't invest in it. Okay. But if you're a believer in crypto and you want to buy crypto and you understand the risk and the volatility that goes along with crypto, make sure it's not a percentage of your portfolio that you're not uncomfortable just losing and saying goodbye to, because you never know where the valuations are going to go. It could go to zero for all that, even Bitcoin. So there's no guarantees with crypto. There's no real underlying value that right now makes a lot of sense. And, ultimately right now, I believe a lot of those crypto assets are essentially, it's just a casino. And, so you want to be careful with it, but we're going to continue to track it ultimately, because I just want to see the correlation relative to stocks. And so far, it's been highly correlated to stocks. When stocks go up, Bitcoin is up at a higher percentage. When stocks are down, Bitcoin goes down at a much higher percentage. So, arguing that it's an inflation hedge, stocks are a perfect inflation hedge. It loses its sizzle there for me, but I'm going to continue to track it. I'm going to continue to do research. I encourage you to do that as well if you're interested in cryptocurrency. There's a book out there. It's called Crypto Assets. It's written by Chris Berniski and Jack Tatter. Sorry if I botched your name out there, but check out that book or on Audible or buy it on Amazon if you want to really dive into the technical analysis of not just Bitcoin but other crypto assets. All right, are we headed for recession? This is a question I get often, when I'm doing talks or if I'm talking to, speaking to clients or just talking to friends and family. The definition of recession, the technical definition of 2 consecutive quarters of negative GDP, or essentially negative growth. So the economy is slowing. First quarter, the economy shrank by minus 1.6%. Okay. Now Q2, the numbers are going to come out unofficially at the end of July, officially probably sometime in August, September. Data will continue to trickle in to confirm the initial data at the end of July. So we're coming up in the next 10 days. And the question is, are we in a recession already? Are we close to getting into a recession? Some of the factors that we want to look at, number one, is inflation. This has been the topic of discussion for all the economists out there, for all the talking heads out there, for financial planners, and for investors. And so inflation is still elevated. And when I say inflation, I'm talking about the headline inflation numbers that the media flashes out there. April, the reading was 8.2. May, the reading was 8.5. June, the reading was 9.1%. These were all 40-year highs. So for those of you that were around in the 70s, that lived through the 70s, this is that era of extreme hyperinflation that led to 2 separate recessions in the 1970s, and they were ugly recessions. So there's definitely concern that given the high levels of inflation, there's a strong likelihood we could be entering a recession very soon if we're not in one already, just simply for the fact that the Fed is going to continue its rate hike path. It's expected, and we'll talk about that in a second, but they're expected to raise rates by another 1.75% for the remainder of this year. So based on what they've already done so far in March, May, and also in June, there's a good likelihood we're going to be entering a recession at some point. It's just a question of how deep is the recession. Is it a shallow recession? Is it a quick recovery? Is it a slow recovery? I think that's really the question we need to be asking ourselves. Now, the two geopolitical events, China's zero COVID policy. One of the issues with inflation ties to the global supply chain, which has been, really in disarray since the pandemic. And a big part of that is because China, everything goes through China. China, all of our economies, the United States included, we are reliant on China. And right now they're in an extreme zero COVID policy. So any positive case that comes up, they are going to extreme measures to have a zero COVID policy, and that's impacting their production, which is ultimately impacting their exports, which is impacting the supply chains across the world, not just in the U.S. but across Europe and other Asian countries. So this is a big concern, when it comes to inflation, and the reason why it's been so elevated in conjunction with energy prices. And the Russian invasion of Ukraine is not helping energy prices. Okay. Now, the United States, we're not a large importer of Russian oil, but countries that are in the Eurozone, countries like Japan, they are heavily reliant, even China, heavily reliant on Russian oil. So given the situation going on with Russia invading Ukraine, there's definitely a lot of concerns about energy prices remaining high, which trickles into the rest of the economy. And that could, again, lead to potentially even more aggressive rate hikes by the Fed going forward. So here are the stats so far. March, the Fed raised rates by 0.25%, May 0.5%, June 0.75%, which was slightly surprising. And the expectation, going forward is that there's going to be a 1.75% total rate hikes for the remainder of the year. So if they get more aggressive than 1.75, I think that certainly could lead to a quicker a recession much sooner than the anticipation, which is likely in 2023. Right now, everyone, kind of all the data that we look at is we're not in a recession today, but it's more likely that it's going to happen at the end of 2022 or 2023. But again, no one has a crystal ball on this. We'll see what the Fed does. We'll see if they look at this headline inflation or if they look at this other data point, which is what I like to look at, which is core inflation. Now, the difference between core inflation and headline inflation is that headline takes into consideration all of the numbers. Core inflation strips out energy and food. Given those are two of the most volatile commodities, if you will, for an inflation data standpoint. And so if you strip those out, core inflation actually peaked so far in March, which is the same month they announced their first rate hike. And so if you look at this, core inflation 6.5, in April was 6.2, May was 6, and then June 5.9. So the question is, are we finally beginning to peak? Oil prices have actually been coming down over the last few weeks. I just filled up my tank at Costco for $3.99. And so it's not amazing, but it's better than it was, just a month ago. So energy prices are coming down. Core CPI has been coming down slowly. And with the continued rate hikes with the Fed, I believe it's a very strong likelihood that inflation has already peaked. And we're going to start to see that show up in the headline inflation numbers as we go forward. Now, another thing to watch is this three bears or this triple bear market. Jeffrey Kleintop from Schwab put this out there. It's a great article if you want to read it. Here's the website here, schwab.com. Learn story, three bears. And what that means is that we are in a bear market, not just with stocks like we talked about, but also in fixed income and in cash. So fixed income is down 10%. That's technically a bear market for bonds. And then cash having a negative return, meaning you take the yield on cash, short-term treasuries, subtract that by inflation. So we are in a triple bear market. There's only two other times this happened in the last 72 years. Both occurred in the 1970s. So there's been a lot of parallels to this economy in the 1970s, which was, it was a tough time. So now the positive is that historically speaking, during these three bear, like when the three bear event officially happened in the 1970s, it was very short-lived. And it actually indicated the peak of inflation, if they were either at the peak of inflation already or it had already peaked. So this is, again, another sign that if I look at the data with core inflation, I'm a strong believer that inflation is leveling off or potentially has already peaked, especially in the core inflation numbers. Another thing to look at is inventory gluts. If you guys remember last year when we did the one of our quarterly reviews, we talked about all the container ships that were just parked outside of the port of LA, and they couldn't get unloaded fast enough. We had this sort of revenge spend, after the pandemic, and they didn't have these there was no one working. Everyone was on unemployment, so they couldn't find the number of people that could actually get out there, unload these container ships, work out those logistics. And so now those orders are starting to trickle in to your local retailer, And so what's going on is that these stores are now stocked like essentially we are working from home, because a lot of these orders were made at the height of the pandemic, end of 2020, early 2021. They are now starting to arrive in stores, and now they're stocked like people are working from home. So essentially, it's a little bit obsolete in terms of the inventory that they have on hand. Walmart says reducing that inventory glut's going to take a couple of quarters. Retail is going to have some problems over the next couple of quarters. Target said they're going to be slashing prices to clear out inventory. So this also further supports the idea that inflation is probably leveling off, if not on the descend, because retail is a big part of the inflation story. And if these stores, these major retailers like Walmart and Target, are slashing prices, that is good news, not necessarily for the growth of the economy, but getting inflation under control, which is, I think, everyone is looking for. Now, one metric that is still kind of, I believe, is going to hold this economy on for a little while longer, and the reason why we're not in a recession just yet, is that unemployment is still really, really low. 3.6%, historically speaking, is extremely low. The 50-year low right before the pandemic, the onset of the pandemic, was 3.5%. So given that consumer spending is the largest component of GDP, I believe that 3.6% unemployment number and the 6.5% wage growth is sort of going to keep us afloat for the short term until the Feds continue their rate hike policy, and then we go into those two consecutive quarters of slowing growth. I could be wrong. We might be already in a recession, but I'm in the camp of maybe late 2022, early 2023. Okay. So now, how does that impact your investment portfolio? Okay, does a recession matter? I actually like to start with the bear market facts. And so this is a piece that was put up by Hartford Funds. I think I sent it to everyone that's on my newsletter already, so I apologize if you've already seen these stats, but just a refresher for those of you that have not seen this. So bear market, average peak to trough, 20%. Okay, we just talked about this. On average, those stocks lose about 36%. So looking at this, we're down a little bit over 20. With the S&P 500, the NASDAQ is a little bit over 30%. There is definitely more room for stocks to fall, I believe, if the recession comes sooner than expected. So we could have a little bit more downside. Maybe we haven't hit bottom yet. But here's sort of the positives to take away from the bear market facts, is that the average is only 9.6 months. They only occur every 3.6 years. And only just over half of bear markets indicate a recession. Now, think about this. The stock market is a leading indicator, not a lagging indicator. So just because, let's say we're in a recession tomorrow, I don't believe the market's going to all of a sudden sell off just because now we need to sell off the market. The market is anticipating a drop in prices. Growth is slowing because of these rate hikes, because inflation is at 40-year highs. And so there's already expectations that maybe we're not in a recession already, but we're really, really close to it. And here's the thing about a bear market. 56% of the strongest trading days in the S&P 500 occur during a bear market. Okay. Now let's talk about bull markets. On average, they gain 114%. So if you compare that to stocks losing 36, I will take staying invested and gaining 114 over time and taking my chances and not worrying about having to time the market perfectly. Bull markets last on average 2.7 years compared to the average length of a bear market of 9.6 months. I'll take that any day. And here's another thing. We talked about the 56% of the strongest trading days occurring during a bear market. Well, another 34% of the best trading days in the market occur during the first 2 months of a bull market. So essentially what this means is, like, before you even realize, the bear market is over, the recession is behind us, essentially you've already missed out on 80% of the best trading days in the S&P 500. So time in the market is dangerous. I highly recommend against it, but there are other things you can do in lieu of time in the market that we'll talk about here in just a second. One other stat out that was interesting is that the broad markets on average, after the S&P 500 dropped 20%, on average they returned 22.2% over the following year. Okay, so again, this is another case to staying invested, sticking to the process, sticking to the plan based on your financial goals, as opposed to the headlines in the news. One of my favorite quotes of all time is by Warren Buffett from an investment standpoint. And the quote is, "Be fearful when others are greedy, and greedy when others are fearful." One of the perfect ways to measure fear and greed, with the stock market is by consumer confidence, okay? Consumer sentiment. So this is an index for the consumer confidence levels over the past, 40 plus years, okay? Or roughly 40 years. If you look at this, right here is where we are today, 50. 50. So this is an historically low number. If you look at these other low points, okay, look at all these figures, right below it is the average return over the next 12 months in the S&P 500. So in 1975, when consumer sentiment was basically at its bottom point, the market returned over the next 12 months, 22%. In 1980, low point for consumer confidence, the market returned 20% the next year. 1990, consumer confidence also hit a low. The market over the next 12 months returned 29%. 2003, 32%, 14%, 22%, 15%. COVID, the most recent, 43%. So we're all the way down here at literally the low point over the last 40 years in terms of consumer confidence. This is where this quote, in my opinion, is relevant. This is not the time to be fearful. This is the time, not necessarily to be greedy, but stick to your process, stick to your plan. This is not a time to reduce risk. This is a time to add risk to your portfolio, assuming the time horizon lines up with your goals, assuming you're aligned with your risk tolerance and a disciplined investment strategy, and assuming you have a well-diversified portfolio that fits within the context of your overall financial plan. If all these check out, then you want to put the pedal to the metal and get more aggressive during bear markets. Not necessarily thinking about recessions, because again, markets are leading indicators, recessions are lagging indicator. Now that we're in this bear market territory, now we need to be looking for opportunities from a buying standpoint. So how do we do that? So here's some actions to consider while we are in this bear market that will add value as the market does recover. And again, the timing of it, no one has a crystal ball in terms of when the recovery happens, but when it happens, one of the ways to fully participate in that recovery is by rebalancing your portfolio when you're in this bear market. So assuming you have a targeted investment strategy, which there's a possibility you don't, maybe you just kind of throw a dart and you just pick whatever 401k investments are available to you, or you picked an allocation 10 years ago and just kind of let it ride. But assuming you have a targeted investment strategy, let's say hypothetically your goal was to be half in the market in stocks and half out of the market in bonds, okay? Well, given the price differentiator so far in 2022, your portfolio might now look like 60-40 bonds to stocks. So 60% in bonds and 40% in stocks. So instead of reacting emotionally to what the market is doing, here's how to be disciplined and create a strategy to rebalance and consistently buy low and sell high. So what you do is you take some of these bonds, you sell them and buy stocks in your portfolio to get it back to the level of 50-50. Okay. So a very simple way to put it is you are selling some of the winners, which the best performers so far is fixed income, and buying some of the losers like US equities, small cap equities, international equities. This is where there's opportunity when the market does recover that are going to shine. Now also make sure there's proper diversification within equities, between international stocks, between value and growth stocks that we've already talked about. So once you've carved out a targeted investment strategy, it's very easy to then over time rebalance based on what the market has done to your portfolio. And this is a great way to remove the emotion from the process. Another way to rebalance is move cash out off the sideline. Many people have been sitting on cash. They've been saving during the pandemic. Maybe you sold a business. Maybe you sold a piece of property and took advantage of the equity increases over the last couple of years. Maybe you had a nice bonus, a good year from a profitability standpoint. Take some of that cash and put it to work. Assuming you have a long-term time horizon, take that cash and put it to work. This is a great opportunity in a way you can rebalance the portfolio without having to sell anything, because all you're doing is you're buying up some of those undervalued securities, again, in US equities, international equities, small cap equities, to take advantage of that recovery when the recovery does happen. Increase your 401k contributions. Very similar concept in terms of moving cash in the portfolio, but doing it within your 401k. So do you have more room to get to the limit of 20,500 if you're under 50, or an additional 6,000 contribution if you're over 50? Do you have room to do an after-tax 401k contribution and convert that to a 401k? Do you have room to do an IRA contribution in addition to maxing your 401k, or do a Roth conversion in addition to maxing your 401k? These are great opportunities to not just get savings into your portfolio and purchase investments at discounted prices, but get these in very tax advantage plans, which is going to really benefit you in your retirement. If you are already retired, make sure your income process lines up with what is going on in your portfolio. So if you have a target of 50-50 and now your portfolio looks like this, well, maybe you're taking a distribution every month or every quarter or once a year from the portfolio. Instead of selling anything from stocks, let those recover. Okay. This is what your fixed income is for. And so use the 60%, which is now higher than the target you want in your portfolio of 50. Use this 60% and take some of those, liquidate some of those positions, some of the short-term bonds that you have, and use that for retirement income as opposed to selling equities. And when the market recovers, then you can maybe switch your strategy and have more of a multi-pronged approach. But you don't want to sell these stocks when you're in a downturn, because this is going to hurt your recovery. And if you are already retired or close to retirement, you can't make it back. You're not adding more to the portfolio. So that retirement income plan is critical. If you've been working with me for a number of years, you understand the process that we put in place is to make sure we're always protecting against selling the losers. We do not want to sell an asset that's undervalued, underappreciated. We want to be buying those assets and selling the asset classes that are more stable during those environments. I talked about this earlier. Take advantage of the higher rates. I bonds are crediting 9.62% annualized. I wrote a blog post on this. Go to my website, read about I bonds and all the different ways you can purchase I bonds, the different limits that you have. CD rates are now not extremely attractive, but they're decent. A little over 2% for a 1-year CD. Treasuries are very attractive. A 1-year treasury at over 3%. Corporate bonds, municipal bonds, they have attractive yields right now. So again, what we've been doing for clients, since the initial wave of rate hikes, is we've been taking advantage of those higher coupons, and we've been buying up some of those discounted bonds, or buying up some of the bonds that are even trading at a premium that are doing 5.5%, or 6% coupon rates. And we're going to plan to hold those to maturity, to make sure our clients can sort of eliminate the volatility with the price increases or decreases, and just make sure they get a solid yield to maturity on the fixed income payments. But look for those opportunities in the fixed income space. Tax loss harvesting. I've also wrote a blog post about this as well. You can go to my blog and read about this. But kind of the gist of it is, you can take advantage of losses in your portfolio, not in a retirement account, but in a taxable account, whether it be owned individually or jointly with a spouse or partner, or a trust account. In these accounts, if you have an unrealized loss on your statement, meaning you purchased an investment for, let's say, $10,000 and now it's worth $5,000 because of the volatility in the market, you can sell that investment and realize that $5,000 loss. Okay. And what you do with that $5,000 loss is up to you. You can offset it against current capital gains if you have any. You can offset them against future capital gains down the road. Or you can use it to offset income in the current year or future years up to $3,000 per tax season. So there's opportunities to use these losses to your advantage from a tax standpoint. And the tax loss harvesting strategy allows you to buy back into the market right away, as long as it's not an identical or a like kind security. So you can't buy Apple, recognize the loss, sell it at a loss, and then buy Apple the next day. You've got to wait a period of time, 30 days, to avoid what's called the wash sale rule. So make sure you look at this, avoid the wash sale rules. They also, there's a lot of gray area, but they also apply to mutual funds and ETFs. So, if you bought Schwab's, large cap S&P 500 ETF and sold that at a loss, do you want to go out and buy Fidelity's large cap ETF to replace it? I don't know. I think that's a little bit dicey. I think you want to look for other opportunities, maybe replacing a passive mutual fund with an active mutual fund, or replace a mutual fund with an ETF that has a slightly different investment strategy, so you can try to avoid those wash sale rules. And there's also unlimited carry forward losses. So if you recognize $100,000 of losses in 2022, hypothetically, you could carry those on for as long as you want from a tax standpoint, to either, again, offset income or against future or current capital gains. So huge opportunity. We've been really taking advantage of this for our clients over the last 6 months. And this is one way to add value from a tax standpoint during bear markets. Here's a huge opportunity right now with Roth conversions. I wrote a whole blog post about Roth conversions in terms of why you should consider them. So I definitely encourage you. This is a lot of plugs for my blog, but go to my blog and read this blog post. It's 6 reasons to consider a Roth conversion. But kind of the gist is, if a Roth conversion makes sense, if you're before age 72, you're not taking required minimum distributions, you're kind of close to that, you're getting closer to retirement or closer to 72, you might consider, and if you have large balances in these traditional IRAs or 401ks, you might consider doing a Roth conversion, pay the taxes now while tax rates are relatively low. And if you think about the Tax Cuts and Jobs Act that's going to sunset at the end of 2025, rates are going to go up for most Americans. There's also a possibility that taxes could just go up in general over time, with things like Social Security, Medicare, Medicaid that are slightly underfunded. If you fast forward another 10 or 15 years, they may have to raise taxes to support those. So if a Roth conversion makes sense, doing it during a bear market is a huge lift, because essentially, if you think about it, you're converting more shares with the same dollar amount. So when the market does recover, those gains that are happening with those shares are going to be occurring in a tax-free account inside of the Roth, not the tax-deferred account. So again, look at your tax situation. You got to make sure this is coordinated with your overall financial plan. This is definitely an analysis we do for all of you that work with us and that understand our process. We want to make sure we do a Roth conversion analysis to see if you're a good candidate for it. But if you are, doing it during a downturn is a huge lift. If you think about a long-term recovery, it's tax-free. Now, finally, of course, being a financial planner, update your financial plan. Has this recent bear market, has it impacted your ability to retire on time? Has it impacted the amount of income you can generate from the portfolio? Has it impacted your risk tolerance? Has it impacted your legacy or estate planning goals? These are things that you should be considering and talking with your spouse or partner, financial consultants, advisors, your tax attorney, your tax advisors, your attorneys, to see what you should be doing now to update your financial plan and see what the impact of this bear market has had on your plans. Because it certainly has had an impact on a lot of people, and likely will continue for a while, because there's a strong likelihood we could be entering in a period of slightly lower growth, slightly lower returns relative to the last 10 years. We've had double digit in terms of stock market returns since 08-09. So we could be in a period of slower growth, lower expected returns over the next 10 years. And so you need to stress test that and see if that impacts your ability to meet those retirement plans that you set forth, a year, 2 years, or 3 years ago. That's it for today, everybody. I hope you found this helpful. If you want to learn more about my firm, you can visit my website at imaginefinancialsecurity.com. You can email me if you have questions directly. My email is kevin@imaginefinancialsecurity.com. And again, make sure you subscribe to our YouTube so you can stay up to date with all of our latest posts. And make sure you follow us on Facebook and LinkedIn, and look forward to connecting with you all soon. And until next time, I hope everyone has a great day and enjoy the rest of your July. Take care.